Welcome to the Furlo Capital Real Estate Podcast, where we dive into the intricacies of real estate passive investing. And our mission is to equip people to invest wisely in both properties and people so that together we can build our wealth while improving housing. I'm James, and this is my wife, Jessie.
Yep. Still here. I don't ever know what to say to that.
Yeah. So,
okay.
All right. So let's have, I listened to this other podcast radio show where they go, well, let's have an on-air meeting real quick. And it's usually them talking about like some sort of like meta thing.
Oh, so like that.
Yeah. So what I do is I think of like something I want to say ahead of time, and then I just launch right into it.
Well, yeah, but you're like running things.
Well, I know. So all right. So let's reverse it. Go ahead, give it a shot, and I'll show you what I mean. This is going to be super fun. On air, we're doing this live. Like,
it's my first time for the intro.
Yeah, and I gotta.
Okay.
I used to do this all the time because my brother used to give the intro, and so I got to practice the response
the jump in
to it. Yeah. Go ahead. We'll give it a shot.
Okay.
Go ahead.
Here we go. Welcome to the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. Our mission is to equip people to invest wisely in both properties and people so that together we can build wealth and improve housing. And I'm here with my husband, James, and we're going to do this podcast.
Yeah. Super excited to be here. And I'm excited that we are no longer being interrupted by our son, who had just come in despite having a recording sign on it. Yes, we are recording this while our kids are in the other room watching a show.
He wanted popcorn. I mean, that's
I get
legit.
It.
They're watching
That's
a
mostly
movie.
because it's dinner time. And he's hungry. But it's all good.
So this is going to be a quick episode.
He's happy. He's happy, and we're here recording, and I'm super pumped to talk about a particular property that I've been looking at.
And that's how you do that.
That's how you do that. So you got to think ahead of time, like what's my little thing.
All right.
That's how it's done.
So it doesn't have to be related to the podcast.
Oh,
it could just be like here's my response.
Yeah. Here's what I'm thinking about. I do that on phone calls all the time, actually. When I'm calling people, like I don't ever call you because, I live with you.
Yeah.
But like when I call one of my parents, I always have like I never try to lead with the, hey, how are you doing? Like I'm always like, I just launch right into the thing. I don't know why. I feel like you have better conversations when you skip the pleasantries and just like get in. And usually it's like off the wall. Like
you do that to me when every once in a while you'll call to tell me something. But I just thought that was like, you do that to me because like, you're not going to be like, oh, hey, babe, what's going on today? Because like,
Yeah. No, I try.
That's so funny.
Yeah. That's the thing. So that's how I do that. Maybe that's just
you typically call and you're like, hey, one thing. Ba. I'm like, oh, okay.
Yeah, or I'll really throw people off because like when they'll call me, I'll like I will think of like while I'm waiting to answer it, like all right, here we go. And you're just like super topical about like here's the thing I was just doing, and I'll just talk about it. And I don't know, it's weird. But
anyways, that's not what we're talking about.
Exactly, not at all. Wow, we're. That's all right. So I'm looking at another multifamily syndication property.
Woo.
Yes. I got so confused at one point because they were talking about it. They were saying, oh yeah, it's in North Bend. And I was like, okay, cool. And they're like, yeah, and it's near the water. And I was like, there's water near Bend?
Rivers?
and yeah, no,
maybe there's a lake.
He goes, no, not that Bend, North Bend, which is near Coos Bay on the coast.
Okay.
So apparently there's a coastal city named North Bend. And then there's the inland one called Bend. Good job, Oregon, for creative naming stuff. Well, I guess you gotta, but I think that just speaks to, honestly, like my geography skills are really bad. I was that kid who in elementary school, they would do like write out how many state names as you can. You got like a minute or 2 minutes or something like that. And I'd top out at like 10. Like, dude, I got this. And I always had like, I got California, I got Texas, I got Florida.
The big ones.
Now I'm like, okay, there's the
East Coast.
I don't know. I didn't even have Oregon. I was like, who cares about that state up top? I might have had Washington because I had Maine. Maine was always a giveaway.
It's like the Four
Alaska,
Corners.
Hawaii. I think that's my 10. And then I would be like, I don't know what, like.
Perfect.
I'm only slightly better now.
Well, you don't need to know where they are necessarily, if you can look it up on a map. But this one's on the coast.
That's true. This one's on the coast.
Okay.
Yes, it is 18 units. They are asking $1.8 million for it, and it is owned by a nonprofit.
Mm-hmm.
Yeah.
Are the units, what's the setup? Is it apartment building? Is it individual units?
Actually, I think if I remember correctly, it's
motel, which I know what that is now.
Yes. It's 2 buildings. They are apartments. One of the buildings has 12 units, and they are all 1-1s. Okay. 1 bedroom, 1 bath. And then the other building, they are all 2-2s.
Interesting.
2 bedroom, 2 baths.
And they're just right next to each other. The same.
Yeah, probably.
Ish.
I actually haven't looked at like the Google Map satellite layout thing to figure it out yet. Mostly because I don't really care until I have an actual offer on the table.
Are they multi-story buildings?
Yeah, they look like they are. And there's like garages or carports under at least one of them. It says they all have some sort of storage related to it. They spend a stupid amount of money on landscaping. And so...
Landscaping?
Yeah, so I'm guessing there's some land that they didn't catch my attention or anything on it. So I don't know. I've never been there.
Maybe they have a little courtyard.
I think I saw it's a 2-hour drive, I think. From our house, and I'm just not going to drive down there until...
So, is North Bend north?
South of us? Yes, it
south
is.
South of us, okay.
Yes, yeah.
I thought it was, because Coos Bay is south. And
Yeah. It's like, when you look at it on a map, if they didn't have labels, you'd think it was just one big city.
Okay, interesting.
Yeah, so, kind of, yeah.
Okay.
Yeah, so it's kind of an interesting situation. Their whole thing was to provide low-income or subsidized housing for folks. And so the way that multifamilies are valued, it's all based off the net operating income. Mm-hmm. So you have your rent minus your operating expenses, basically everything except for interest and mortgage payments. Mm-hmm. And that's the magic number. Mm-hmm. And then there's some magical other number that you divide by that tells you what the value of the property is going to be. And that's just... You derive that from other comps. Essentially, they will do rent. They'll do surveys. Hey, what's your NOI? Would you buy it for? And that's how they'll figure out like what that ratio is. It's usually in Oregon, it's kind of going to be in that like 5 to 7% range. Mm-hmm. And so the math is really simple. If you want to increase the value of a property, you increase the net operating income, and there's a direct correlation to its value going up. I mean, that's what banks use. That's what appraisers use for those bigger places. Okay. Not true for single-family homes. That's all determined based on comps in the market. But for bigger properties, that's the deal. Yeah. So if you get a place like this where they are purposely keeping rents low, their net operating income looks horrible.
Super low.
And so if you were to do like the regular math for what this place would be worth, it's worth maybe like under $1 million. It's like maybe $980. So they're asking twice as much for what it should be. Interestingly, rents are not half of what they should be. They're not quite that subsidized. They're like 20% below the market in that area. I think that's right. Let me check. No, I lied. They are half. They are, their current weighted average is 676. And it could be averaging closer to 1,000.
Wow.
So those 1-1s are getting 624 on average, and the 2-2s are getting 780. And I've got my laptop here with all my numbers. And so for those 1-1s, instead of the 624, they could be getting 950, which is like a 52% increase. And for the 6-2s, a lot of numbers here. They are getting 780, and that could be 1,100 based on just what I saw. Yeah, which is like a 41% increase.
And that's based on North Bend numbers?
Correct.
For rents?
Yeah. Rents in that area. Yep. So it's one of those weird deals where when you buy it, the initial numbers look horrible.
Right.
But there's 50% upside on it, and so it can actually look pretty good at the end. Here's the other problem that you have. In this lending environment, a lender wouldn't touch that. Yeah. Because when I looked at it, when I did the in-place estimate, the net operating income is not enough to cover a mortgage. Which is kind of a...
So as a nonprofit, they're
Well, they paid cash for it, so they don't care. Or they didn't. They bought it for like $1 million is what they bought it for, which honestly is... So they ran into problems, right? They've invested a ton of money into it, but they never really increased the rents. And so guess what? It's still worth $1 million because of the way the math works.
Right.
And which is hard, but yeah, that's how it is. And so so it's a really cool organization. They help... Their whole goal is to help people with like mental health issues. And so not only do they provide like this housing option, but they also provide people to come in and care for them, to work with them. They have a special heart for veterans specifically who are dealing with mental trauma. And and so that's their whole model. And they've, like, from what I can tell, they're really big. They're all over Oregon.
So why are they selling this property?
Yeah, so they bought this one to turn it into one of those facilities.
Okay.
And somewhere in the process, that no longer became an option.
Oh.
And I don't know if it was the city or them or whatever, but now they own this building and they're not...
And they can't run
do what they want to do. Okay. And so, as a good nonprofit should do, it's not part of their mission. And so, like, well, let's sell it. And they're more than likely going to go find another place.
Yeah, that they can run that way.
Yeah, and I would not be shocked if, however we structure this deal, they then parlay that into their next thing.
Yeah.
And at least that's what I would do.
Makes sense. Have they already started running it like that facility, and then they had to shut it down?
I know that their rents are low, so in that sense,
it's subsidized already. But
I don't think they're offering care.
I guess I'm just thinking.
I don't know who the residents are.
Yeah,
I know a lot of them are on HUD.
Okay,
I think
because that's what I was thinking. Numbers. Is like I know that we have experience buying an apartment building where we had to rehome everybody.
Yeah.
Based on, lots of
them
factors.
All having a sex offense.
Yeah. And so I'm kind of like, if you did raise rents, like you're talking about, the people who are currently living there probably wouldn't be able to stay.
Yeah.
Or afford it or qualify. Mm-hmm. And that is just a factor that you have to think through.
Yeah. And I think that'll be part of my due diligence period, really trying to figure out, who are these 18 souls and what makes the most sense for them. They have a couple vacancies right now, but that's it. Only a couple.
Which it sounds like if this nonprofit has other places that they offer the same thing, perhaps that's an option for some of them. Yeah. I don't know, but
maybe. Yeah. Yeah, I don't know. That's a good question. So that's so that's kind of the overall situation. And again, what makes this really hard is they're asking $1.8 million, which is not a small amount of money.
Yeah.
But you can't go get traditional financing on this thing because the numbers just don't work for something like that. Yeah. And that's like, you can make the argument, well, that's because of higher interest rates. Well, that doesn't help. But even in like low interest rate days, like this just didn't work.
Yeah.
And so I tried to structure something that would make sense. I also learned that they did get a couple really lowball like cash offers, which just means they bring their own financing.
Yeah.
And my guess is, it was like 1.1, 1.2 range. That's like not knowing, but having run the numbers, that's kind of like that 1.2 was right about where like things started to break even, and you go, okay, that makes sense. So I am offering them $1.8 million for it.
Okay. I mean, that's what they want, so...
Yeah, so why not?
Do you make money?
Oh, that thing. Yeah, so one of my skills, I think, as an investor is, besides having awesome spreadsheet skills, is I'm willing to be creative and think things through. And I'm not necessarily, like, I'm willing to be creative and enter into a seemingly messy deal and have a lot of moving parts and try to figure out how to make them all fit together. And we got another deal that we should be closing on tomorrow. And that is like the messiest of messy deals. We're not gonna talk about that right now. I'll do an update on that one. It's actually, we talked about it in the previous episode. Yeah. So you can catch up on that one. And we'll do an update at some point. But the plan is to do 20% down, and I will raise those funds from passive investors, and then have them give me a note for the remaining 80%. So, quick math for you here. So I'll do $360,000 down, and then they'll give me a loan for $1.44 million.
Okay.
is kind of the idea. Now, here's how we make this interesting is, I think I got to update a number here. If they're a nonprofit, it's weird. Like, the rules around accepting interest payments are weird for some reason. And I honestly haven't looked a lot into this. And so what I'm about to say may be slightly wrong, but this is how they came at it, where they essentially were like, we don't want to do, they're willing to do a seller note, but they don't want to do interest.
You're because like, great.
Because it can cause some sort of issues with it. And so there's things you can do to get around it. But essentially, it's like, all right, cool. Yeah, 0% interest. Let's do principal payments only. I want to do it as if it's a 25-year term, but it's amortized as if it were a 25-year loan. But there's a balloon payment in 10 years. So I'll make a bunch of payments, and then 10 years, boom, we'll write them a massive check. That'll essentially be a refinance at that point. And that's the plan. And yes, I will absolutely lose money for the first 6 to 7 months on this deal. And so part of what I need to do, I'm not going to raise $360,000. I'm going to raise $600,000, partly because I think there's some additional repairs, like $100,000 need the repairs that will need to happen. Like I'd like to repaint the buildings for one, like a pink color. They're okay, but I think that could be modernized a little bit. And there are I think 4 units remaining that they haven't flipped yet. So we got to save some money for that. And, but I'm going to raise $600,000. And part of that is to help bridge the gap from that, like, hey, we're going to be like losing money for those first few months until we can get some of those unit rents up. And part of what I need to do,
like, just to clarify, the reason that it's losing money is because the rents are so subsidized. They kept them so low. They're not even making enough to pay the mortgage.
Well, they don't have a mortgage.
If they
had one, which is why they paid cash for it. So
they're not making very much money.
I mean, I've got to assume that they're getting some sort of donations as well.
Okay,
coming in, so that's also
to keep this thing running.
Yeah, that's my guess.
But as the investor, you would be losing money because the rents are so low.
Yes, correct. Yes,
and you can't just. I mean, you could, I suppose, just kick everybody out and raise them all.
No, not in Oregon.
Oh, that's right. That's right.
So part of what I need to do for my due diligence is actually get my hands on a rent roll, figure out how many people have been there, when was the last time they received a rent increase, and then make some like actual detail out the plans.
Okay.
So right now I have it like taking a year to do all those repairs and fixes, and then in that amount of time also like increase some of the rents.
Sure.
But no, it's gonna like going from 624 to 950, like that's no joke. That's gonna take some time. And so that's part of like this will be a longer term hold, and it'll, again, I think we'll have enough other things that change where we'll break even like midway through the year.
If you are thinking about that amount of rent increase and the amount that you can increase per year in Oregon or per person or however that works.
Yeah.
What's your projected time frame for when you would like break even and then make money?
Oh, yeah.
You kind of hinted at it.
And I don't fully know the answer, to be honest.
You'd have to, that's what you were just talking about. You got to do the math.
Yeah.
Okay.
It's one of those where my guess is like if no one ever moved out, it's going to take 3 years. That's my guess.
Yeah.
But someone always moves out. And so and there's people who have just recently moved in. And so there will be some early opportunities to change it up. And I think you go to like some of those newer people and it depends, like hopefully they're all on month to month. If they signed a year-long lease, I guess I'm hosed, but actually I just wouldn't mind it if they signed a year-long lease, because then we could just say, hey, we're going to create a new lease and it's at the new rent rate. If it's month to month, that's a little harder. And so essentially what I'll have to do is, and so like it depends, but like one option is to say, hey, I'm giving you a 90 days notice to move out, or you can accept the new rent. Which one would you like to do? Just kind of let them choose which one.
How is that different than just kicking them out and raising the rent?
No, well, you can't do that for everyone. If someone's been there for longer than a year, you don't have a choice. Like you can't just kick them out to kick them out.
You can't give them 90 days notice.
Correct.
Yeah,
it has to be for cause. They have to have done something.
Yeah.
Is kind of the idea behind it. If they are on leases, then when that lease resets, you can renegotiate a lease and just say, no, I'm not going to renew it unless unless you do the new rent rate.
I understand.
Yeah, it's kind of an interesting. There's pluses and minuses to
just
both.
Having a lease. Yeah.
Yeah.
Okay. Yeah.
Or doing month. There's pluses and minuses to a lease and to doing month to month. Just kind of decide.
I have another question. Yeah. So, as an investor, you're telling me that I would invest my money so that you could do some repairs and float the property for a little bit until you were able to raise the rents, get things fixed and raise the rents so that it was at market value and cash flowing.
Yeah.
What is the return that someone might get?
What is the return that someone might get? I have a couple other assumptions in here that I think are important to point out first.
And then you're going to calculate also like how long they'd have to keep their money in the deal.
Yeah, I've got it at 5 years right now.
Okay.
Yeah, but
is that just like you set a time and then you do the math and you nuance it and you're like, actually, it'd be more like 3 years before I can start paying things out.
I actually have a really cool. Well, okay, you're saying a couple things here.
Yeah, no, I asked about your question.
No, it's all good. The payouts will start relatively soon. They'll start within that first year, but we won't sell it for 5 years. So those are two different things. And I have a really cool sensitivity analysis thing that tells you like, here's the optimal time to sell and or refinance also with that, which by the way, the answer is always like the second you hit whatever your goal is, sell it. That's always the answer. So if you say like this thing will take 2 years, like sell it in 2 years. I always say 5 because you're like, well, like these things just take time and we got to build that kind of flexibility into it. But yeah, as a general rule, it's like, no, the best time to do it actually, yeah, the time for this one would be to do all this stuff, and then it actually says to refinance it because that would because that would just return a bunch of money really quickly up front, and so that maximizes the return to everyone because then they can go do their cash for other stuff, and then from there it's like, man, how long can you hold on to it? I mean, it takes it from like a 16% return to like a 35% return if you're able to refinance it after doing all those changes and repairs. And again, the only reason why is because you return a chunk of money back to the investors, and the way that the returns are calculated in a way that's time sensitive. So money sooner is a lot more valuable than money later, even if they're the exact same number. So
weird.
So yeah, back to your other question about what are the returns, even though I kind of just told you, there are like, when I was underwriting it, there were a couple other things that caught my eye. And so some assumptions that I have in here. For example, one of their things was that their insurance is like almost 10 grand a year, which you don't know this, but our 11 unit apartment building is $3,000 a year.
Oh, that's a big difference.
That is a huge difference.
Yeah.
I don't know why. And that's something that I would have to find out. But for now, I went, well, let's adjust the assumption. Instead of it being 10 grand, I'm going to say it's only 5 grand. And it could be one of those weird, like, they're a nonprofit and that somehow matters. I don't know. Could be in a floodplain for all I know, in which case, wow, my number's way off and we'll have to revisit this with them. Another one is they did not have any repairs or maintenance.
Oh, nothing set aside.
Nothing in the P&L that they shared. So so essentially I took the 5 grand from that and I put it into into repairs and maintenance. Went, all right, we're break even now. And then the other one, which I thought was really interesting, is they had a garbage number that was really, really high. And so, I don't know why, but essentially, like for our trash can, we pay $280 a month for our trash can for 11 units.
Oh, for the apartments.
Yeah, for the apartments. And so I just doubled it. But man, why not? Which comes out to $6,700. They're currently paying $12,400
a year.
Yeah. Maybe they have 4 trash cans.
It's a lot of garbage.
I don't know. They could be a different garbage person. Again, it could be the coast.
I guess
I don't know.
There's 11 units versus 18. So.
Yeah, but my single trash works for 11 easily. So I feel like 2 would cover it just fine.
Yeah.
So I don't know. Huh. So those are some of the, but wait, they are also paying, and I gotta like, these are just interesting numbers. they are paying a lot for water and sewer. And so I put it in there where we're going to transfer something. We're going to do the RUBS system with them. And so, which stands for Ratio Utility Billing System. And so I've got a portion of that being billed back to them, which I just think will offset.
I mean,
which, by the way, is totally separate from a rent increase.
That's what I was going to ask does that count towards the rent increase number?
No, it does not.
It just changes the structure.
Yep. Yeah. You're essentially changing the terms of the agreement.
Does it actually, like the overall rent, does it affect that number? Like, would you adjust the rent down because now you're charging them for utilities?
I wouldn't.
Interesting.
No.
So those rents, market rents and comparisons are assuming that tenants are paying their own utilities.
I don't know, actually. Some of them do. Some of them don't.
Huh.
But they will here.
Interesting. It's kind of weird.
Yeah, that's like that. Like, you know how when you go onto an airplane portal to look up plane flights, and they'll all have their numbers listed, but some of them include a baggage fee, some of them don't. Some of them make you choose a different spot than whatever, and some of them charge for like breathing, all that stuff. And the goal is they disaggregate a bunch of those numbers so that when it's all in a list, you see the lowest. And there's all sorts of pricing psychology around it, which I find unbelievably fascinating, and you get annoyed by. Some of that happens here too. So I think there's people who have a rent number, and to get it to look as low as possible, they don't include any of the utilities, and some who do, just because like whatever, like it's just included is what it is.
Interesting.
And so you got to kind of read some examples of that. So I don't know. It's probably a mix, is my guess. A lot of it probably depends. Like if it's a single family home, they're paying all the utilities. No question about it. Everyone's paying electricity. My guess is everyone's going to pay gas, depending on the type of gas. My guess is waters and garbage are ones that like the landlord is actually paying, and now it's just a question of are they billing it back or not. Yeah. And it's one of those things where the software is finally caught up, where it's pretty easy to do it. Yeah. So I think a lot of landlords and property managers, like for example, when we did it on 14th Avenue, that was her first time ever doing it. She was like, "Oh, I don't know how to do this." Turns out it was built into AppFolio. I was like, and I looked it up for her. I was like, "Oh yeah, it's super easy. Here's how you do it." And she was like, "Oh yeah, that was super easy." And so now she's starting to implement it in other places because she was like, "Oh yeah, this is really easy to manage." So that's happening.
Yeah, a lot easier.
You're welcome, Oregon, for helping your rent price go up, because I taught at least one property manager how to do it.
Well,
so
it sounds like you have a lot of assumptions still.
Yeah.
And need to do some due diligence
on still very early on this.
What their numbers actually are or could be.
Yep.
And why are you offering them the full price? I mean, if you don't think it's worth that, why pay that?
I think it is in the long term. So my return to investors is still going to be 16% IRR. It's still going to be the cash on cash.
What am I missing? Like, you're paying asking price.
I am paying asking price for what the value of the property will be 2 years from now. That's what I'm doing.
But it's not worth that right now.
Not right now, correct.
So you're going to lose money initially.
And part of what helps this all make sense is if they are willing to accept seller financing with zero interest, it's almost as if I'm paying cash for it. The debt is so cheap that it helps the numbers make sense.
Okay.
Actually, I made them a video to go with my letter of intent. And in this video, it was like a little 3-minute thing. I explained to them, I said, hey, look, because I generally they have a really cool mission, and I'd like them to get enough funds to continue to go on. And so that was kind of the hat that I put on. It's like, okay, how do I get them the full 1.8? And, because I'm on a board of directors at a nonprofit, they actually sold the building at one point and now have getting funds coming in for a few years. And it's been awesome for the organization. And so that was kind of where my hat was like, or my thinking was like, okay, how do I get them that max amount? And so by them doing the seller financing and structuring it this way, it gives them the full 1.8 eventually. And at the same time, it allows my investors to make returns. And I told them, and what I said in the video was like, there's this balance here. Like, I can't just pay you whatever you want because I have to raise money to do this, and my investors need to make money as well. And so it's like finding that happy ground. And I think that was part of my, like, I'm creative enough where I feel like, at least right now, given the assumptions that I have, I feel like I've threaded that needle for like, okay, I can get them what they want, and I can get investors a good return that they'll be interested in investing in this property. And yeah, there's a little bit of risk there in the sense of like, yeah, it's losing money initially, but from what I've seen, it's a really simple plan. It's the building itself is in good shape. They've invested $500,000 in fixing this thing up already. Like, it's got new roofs. They've already turned, whatever it is,
14
units. Is that right? Yeah, 14 units. And so
you can do math.
I can do math. Dude, we were doing something with the kids earlier today where they were asking me questions, and I was just like, I was so far off, it wasn't even funny. And even Samson was like, man, I thought the answer was like 1,600. And I was like, because I told him like 1.6 million. And he was like, huh. It wasn't 1,600? And I went, oh no, totally 1,600. I added so many zeros. I'm sorry, buddy. I'm like, you totally are right on this one. And that's where Eleanor, she was like, Dad, you gotta do better at math.
Oh,
dude, no doubt. I'm like, that's why I have Excel.
Double check, triple check,
well, she
everything.
Goes, I thought you do like more advanced math than this. I'm like,
so
well,
funny.
like, not on my head. But yeah, it's pretty funny. But yeah, so that's how I was. So there's some risk at the upfront that like, okay, well, what if I can't increase rents that much?
Yeah.
Which is why, if you listen to the previous episode, we were talking about how to talk to and look at a property manager. Like, that is why that is so important, because I have to have confidence that whoever I'm working with, that they're on board. They go, yes, you can do this. We have a plan. Here's how it's going to work. That's why that's really important. Yeah. I also have a plan with the RUBS and saying like, okay, we can do this to get the rent up. Thankfully, there's not a huge rehab component to this, at least from what I can tell. Now I'll get there and I'll walk through and I may change my mind based on what I see, because it is on the coast. Yeah. But I mean, the pictures look pretty good. So yeah, that's kind of that's how I can offer them what they're asking. And through, it's a form of creative financing, though it seems really straightforward, able to say like, yes, we can make this work by essentially ballooning this until the property value has gone up enough that it actually is worth 1.8, and now I can pay that off. Yeah. And at that point in time, we're either selling or refinancing, and the market will kind of determine what we do there. That's kind of that's the deal.
Super helpful. That was a great description.
Yeah, so I'm excited about it. It's fun. There haven't been a lot of opportunities in Oregon so far this year, and so this is one where it's funny. I actually looked at it initially, and I was just like, I don't know, man. These numbers, like, they won't. I had that initial reaction, like, oh, they want way too much. It's only worth like 1.2, 1.1. Yep. But then I started diving into like, okay, well, what about this? What about this? Looking at the numbers, and then when I landed on like, okay, they're willing to sell a carry. If we can structure it this way, I can actually get them what they want. And because I don't know, I feel like I would have to come with my own financing. And even then, like 1.2, I don't think they'd want that. They've invested they bought it for $1 million, they put $500,000 into it. Like, they want at least 1.5, 1.6 for it. Like, that to me makes a lot of sense. Yeah. And so at that rate, and the numbers just don't work because they don't have the NOI to support that for a while. Yep. And so if I can structure the debt in such a way where I'm giving them the money instead of a bank, like that to me, I go, that's a win. Yeah. And so that's the hope. But we'll see. Like, I haven't heard back. I got the draft. We'll probably send it either tonight or tomorrow morning is the plan. And
for the offer.
For the offer, okay. Yes.
Because you did a letter of intent.
No, that's what I'm sending them.
Oh.
Is a letter of intent.
Got it.
Yeah, so when you get into a bigger property, you can just do a purchase and sale agreement, just like normal, right out the gate. But oftentimes you'll just start with a letter of intent because it's just a lot easier, and you just could like real quickly see all the terms, how they're laid out. The other interesting part about this one is it is run by a board, and my experience has been not everyone's a number wonk. We're not talking about typical investors here. Yeah. Now, from what I understand, like, their whole business model is buying these buildings, doing these things. So they're going to be more sophisticated on real estate than normal, or at the very least, they've got a really good advisor.
Someone who is. Yeah.
But part of the reason why we did it the way we did it was that so everyone on the board could read it and ideally go, yeah, okay, I understand what he's proposing.
You wrote it for me.
I wrote it for you. Yeah.
That's the premise of this podcast.
You read it, I guess, to make sure that it made sense.
That's all right.
No, it's all
I'm
good.
sure it's fine.
Yeah, I'm sure it'll be all right. I don't know.
I've read enough of your things.
We'll see. Or we may never talk about this again because they said no. That's how this will go.
And then I should have read it.
Yeah, that's all right. Yeah, it's all good. So there you go. That's the property. And thank you so much for listening to us go down those rabbit trails, especially at the beginning. And so we would really appreciate it if wherever it is that you listen to podcasts, you leave us a quick rating and maybe even a review. Oh, let's get crazy. Yeah. So again, thank you so much for listening and have a great day.